Hey ambitious dentist, welcome to Start Your Dental Practice, the show for existing and aspiring dentists to take your dental practice to the highest possible level. I'm your host, Jonathan Van Horn, CPA and ABV, founder of dentistmetrics.com. In every episode, we aim to demystify the how to start a dental practice problem by bringing on world-class dentists, influencers, and consultants in the dental industry to pick their brain about how to get past the barriers involved from going from no practice to being a practice owner to owning your own successful dental practice. Hello, ambitious dentist. Today, I have a special podcast episode. So instead of having an interview today, we're actually going to be discussing something more informative. We're going to be teaching you something, and we're going to be talking about dental practice loans. It's something that every one of you is going to need at some point in time in your professional career. And in today's episode, we're going to talk about why I'm doing an episode like this. We're going to talk about my personal business philosophy on debt and why it should be yours too. We're going to talk about the different reasons for bank loans. We're going to talk about the different types of bank loans. We're going to talk about the different features included in different bank loans. So there's a lot of varying moving parts in these loans that you need to be educated on before you go to the banks. And then we're going to talk about my number one takeaway from doing business with the banks. And so at the end of this episode, I actually gathered questions from many listeners of the podcast, clients, readers of the blog, people on my email list about bank loans. I then talked to 6 of the biggest dental banks out there, loan officers, and I took those questions directly to them, a little bit more advanced, a little bit more specific than what we're talking about today. What we're talking about today is a little bit more informative, but if you want a copy of that guide, so I took those 6 giant banks, compiled all those questions in an easy to read format, and turned it into a guide of how to successfully apply for a dental practice loan. So you'll need to listen to this podcast first and then read that guide, but that guide will be our bonus today. So listen all the way to the end to be sure to be able to learn how to receive a copy of that free guide that will allow you to successfully apply for a dental practice loan and even give you a direct way to contact those big banks when you're ready. So now on to today's episode with me. So the reason that I'm doing a podcast that is a self-done podcast, an instructional podcast, rather than a conversation between another doctor where you get to learn from other people's mistakes, is that I received a lot of feedback saying that they'd like to hear my personal take on some of the big common pitfalls that dentists have when starting a practice. So I was kind of brainstorming on different areas to do this in, and I said, let's start at the beginning. So the beginning is the dental practice loan. Everybody has to get one. Everyone has to go through this process. It's almost like an initiation for everyone. You got to kind of go and play with the banks and to get the money to come in. So I've seen a lot of people be confused with this process. I've seen a lot of people get stiffed with this process. I've seen a lot of people fail during this process. So they fall on their face before they even get off the starting block. So this doesn't have to be complicated. You just have to have a little bit of education about what is going on in this process. And that is what the purpose of today's podcast episode is to arm you with the basics of the information. If you go all the way through, download the guide, read what the bankers are actually saying are the best things to do, and you will greatly increase your chances of successfully starting a dental practice with a bank loan, as well as saving yourself some hidden costs and fees that happen during this process. So I hope it's really valuable for you guys. There's one other reason that I'm doing this that I have to talk about because I'm a proud daddy. My wife gave birth to our second child, our little boy, last week, and with all the craziness that comes from having little children, or a baby that just cries and screams and doesn't sleep at night, I didn't have time to actually find an interview for this week, so it is a little bit self-serving in that regard as well. So just full disclosure on that. So I really hope you enjoy this episode. If you do, shoot me a quick email, jonathan@dentistmetrics.com. Let me know you enjoyed it. Let me know how I can make these informative podcasts a little bit better. I'm really passionate about this stuff, so I hope it comes through in the podcast episode. But give me some feedback. Let me know how this one goes, and I'd really appreciate it. So my personal philosophy on business debt is very intentional. So if you're a fan of someone like a Dave Ramsey, which I am for personal debt and things like that, he teaches you to, in today's day and age, we need to be debt averse, which means we need to be scared of debt. We need to eliminate debt. We need to fight it at all cost. I am a big fan of that. I hate personal debt. I hate car loans. I hate my mortgage payment. It drives me up the wall that we have to make these payments month after month after month for things that we've been making forever, and it just drags us on and on and on and on. And I know I'm speaking to the choir or preaching to the choir whenever I say that to dentists that have these giant student loans. So we are a generation of, or the current generation of graduating dentists is the most debt-averse people in the history of the world. And the reason is because, let's be honest, the people selling us stuff know that there is opportunity to charge more money. And so if they charge more money over time, the costs go up, debt goes up. If debt goes up, then people become more averse over time. So the most important distinction I can give you if you're in that camp, first of all, I applaud you for being in that camp because I'm in that camp from a personal perspective. However, you have to be able to separate business debt and personal debt. I like to call business debt smart debt. And the reason is very, very, again, intentional. And it is because if you take out a loan for, let's say, $100,000, and you could put that money, and they just give you the money, no conditions, nothing else on it, it's just they give you the money and say, okay, pay it back in 10 years. And you knew that you could put that $100,000 into an investment that was going to make you 10% a year. So on that $100,000, you're going to make $10,000 every stinking year, no matter what. And your payments to the bank were only 5% over the course of the life of that loan. Would you do it as long as you had enough cash flow to be able to make those payments every month? Yeah, absolutely. You do that over and over and over again because it would effectively be free money at that point. Well, that's not as far off from dental practices and business debt as you would think. So for example, if you're like the average startup practice and you're going to be doing somewhere around $400,000 loan, $500,000 loan with working capital to get started, you are going to, if you just hit the average for startup dental practices out there, you are going to actually bring in $250,000 in revenue this year in the first year out of starting that practice. Now, you won't net that amount because you'll have to make money yourself. You'll have to pay yourself. You'll have to, take money out to be able to make payments and things like that. But the national average, like the kind of the low end of the spectrum, is around $250,000 for a startup practice out of the gate. As long as your business systems are in place, it is not unreasonable to double that the second year. It's not unreasonable to go up to $750,000 the third year out, and it's not that uncommon for for people to even smash through those numbers. We just had Dr. Colin Lathrop on a week or so ago, and he talked about how within 2 years he's almost at $1 million. And if you think about it, that's a 200% return on his loan that probably was either a 7-year or 10-year note that he's been able to get in revenue. Now, he has costs that go with that, obviously, but as long as your business systems are set up in place, that is very, very smart debt, because you should be able to structure things to be able to be profitable in those situations. As long as you have a good team behind you, as long as you have good advisors behind you, as long as you are educated, you should be able to make money off of that. So It's different than personal debt. I call personal debt dumb debt. I call business debt smart debt. And the reason I call it smart debt is because it allows you to achieve something you couldn't do on your own. Mark Cuban, a really famous entrepreneur, once said that you'd be an idiot to take out a loan to start a business in today's day and age. The problem is that does not apply to service-based businesses that have a lot of equipment purchases up front and a lot of other costs up front. Now, if you could go next door to a place, next door to your house, if there's a little office complex, rent a room, get it be sterile, things like that, get a cheap seat, and just have one person come in until you had enough money to open up a second room and keep growing like that, and do that, pretty much debt free. But that doesn't make a whole lot of sense whenever, doing it that way would take you so long to get up and running when you can just borrow the money, a reasonable amount of money, and really, really supercharge that growth. So those are really the two alternatives on that. Or you could just continue to work for someone else forever and be at their mercy, which is definitely an option. And there's some people out there that, God bless them, that's what they want to do, and there's nothing wrong with that. But I'm assuming if you're listening to this podcast, you're not one of those people. So I want you just to kind of understand the business philosophy of debt, and it is boiled down, bar none, it is that money will earn you exponentially more money than it will cost you in interest whenever you pay everything back. So given that this money should be bringing you back more money than it costs you in interest over time, here are the different reasons people get bank loans. So the most common in today's day and age is practice acquisitions. So you're buying a practice from someone else. There's not very many of us that can afford to pay, $600, $700, $800,000 out of pocket. And if you can, great. I'm very happy for you. But you are the exception, not the norm. And the best way to do that acquisition is to go through a bank loan. It's very, very common, and your seller should be very aware that that's what you're going to have to do. So the second reason that's the most common is in today's day and age is startup practices. So when a dentist has decided to, there may not be an acquisition available, there may not be any acquisitions that they like, or they just may want to, build a better mousetrap and build their own practice, and so they do a startup. There's lots of banks out there that will give you a loan to do a startup practice to build it out to the specifications that you want. Another reason is for mergers. This isn't that common to my audience, but a merger would be whenever you already have a dental practice. There's another dental practice in the area, and you say that, hey, we want to join forces. Let's merge our practices into one entity so that we can share some overhead cost. And sometimes that comes with an additional cost from one practice to the other, because one practice will have more in collections than the other, or have some, one practice may have a CERT, one may not, and so you'll need a loan for that to get that to work out from one side or the other. Another common reason is for large equipment purchases. So you'll look at the amount of, if you're wanting like a CERT or something like that, you can go through the banks to buy a lot of these equipment items. You don't always have to go through the equipment companies to make those purchases, and a lot of times the banks will actually give you better terms than the equipment companies are, because the equipment companies, they will loan you that money, but it comes with a cost. And really the last most common reason, there's a bunch of other reasons, but the most common reason is, there's two more. The second to last is to optimize your cash flow. If you already have a practice up and running, sometimes you'll have old debt that is a high monthly payment and you want to refinance it, or you have no debt and your cash flow is just not really great right now and you're needing some additional working capital. So optimizing cash flow is another reason that people get bank loans. And the last most common one that we see today is partnership buy-ins. So you're an associate somewhere and you're going to buy into another dental practice. That would be a partnership buy-in. And many times that has a loan feature a part of it. Sometimes the existing partner will owner finance a portion of that or all of it, or they'll say that, until we get to this point, then you don't owe me anything, and then at that point you're going to owe me this amount of money. There's a million different ways to skin that cat, but that is one of the other reasons that you might get a bank loan. So there are two main types of bank loans. The first is a conventional loan. So when I say conventional loan, that effectively just means that the bank has decided they're going to loan you the money and you're going to pay them back over a certain amount of time. That loan is secured by the bank. So if something happens to your practice, if something happens to you, it is on the bank to collect that money either from yourself or from the practice or from the business assets of that practice. Typically, conventional loans are the way you want to go if you are buying a dental practice from another owner, or if you are doing a startup practice without buying real estate. So the other type of bank loan that is very common is an SBA loan, a small business administration. It's a government-backed loan, effectively. Lots of banks will offer these. You really need to understand if you're applying for a conventional loan or an SBA loan. So why do you need to know if you have an SBA loan? They're just giving you the money, right? No, not right. SBA loans are going to have higher fee structures, so you're going to pay more up front. A lot of the times banks will wrap these up into the loan balance so you don't see them, but believe me, you're paying for that SBA loan. Sometimes you can pay up to 3.75% if I remember correctly. So if you get, let's say you get $1 million loan, you're going to pay almost $40,000 extra for an SBA loan if you go that route. So when does it make sense to do conventional versus SBA? I talked about it a little bit when I just talked about the conventionals, but SBA is great for real estate. Lots of banks can't do the real estate portion in the conventional aspect, but they can do an SBA loan for the real estate portion. So my rule of thumb, if real estate is involved, try to get a conventional loan first. However, if that is not available, if you've gone to a few of the bigger banks and they said, no, we can't do that, then look at an SBA loan. However, you really should not have to get an SBA loan for any practice that does not include real estate. So if you just listen to this part could save you lots and lots of money over the long term. So please remember, if you remember anything from this interview or this podcast, only go SBA if you're needing real estate as a last resort. And the reason is because of those fees. There's also some guarantees in a lot of SBA loans. Some dentists can get out of this, but long story short is sometimes the SBA will secure the loan versus your house, because SBA is a government-backed loan. Conventional loan is backed by the banks. SBA is backed by the bank plus the U.S. government. If the U.S. government is involved, you're gonna be kind of tied to a post if something happens. And the SBA loans a lot of the times will secure themselves versus your personal residence. They will be able to come after you for your debt for a longer period of time if something happens. So be very aware of if you're receiving an SBA loan or a conventional loan. If you're getting an SBA loan, see if you can split that loan to be SBA for only the real estate and then conventional for the actual equipment purchases and the line of credit and the build out and all those other things that come along with the practice, and put those into a conventional loan as well, because you really want to limit your exposure to the SBA loans if at all possible. So given the conventional and SBA loans, there are other little nuances that I call features of bank loans that you really need to arm yourself and be aware of. So here are what these different features are. So number one, closing cost. So if you've ever bought a house or anything like that, then you know that you have closing costs. So closing costs for like a personal residence or something like that can be somewhere between 2 to 4% of the purchase price of the of the property. So if you bought, say, a $500,000 house, you could be paying anywhere from $10,000 to $20,000 in closing costs. Those are costs that are incurred that you pay to the bank for doing all this work to get this bank loan up and ready, the legal work, the underwriting, all these other things. With dental practice loans, you should not be paying very much in closing cost. I've seen closing cost as little as $1,000 for $750,000, $1 million loans. So be very aware that if you are closing on a loan with the big bank, you probably won't be doing a lot of a closing cost. If you're with a small bank, a local bank, this is where issues come up, is in these features. So the closing costs are typically going to be high if you're going through a small local bank. In addition, you're probably going to have a down payment with a small bank versus a large bank. If you're doing a dental practice loan that is from a big bank, you're not going to have any down payments. It's just how it is. Assuming that the deal is a normal deal, you're not going to have to put any money down. You're not going to have to put 10% down, 15% down, 20% down, or anything like that. With some of the smaller banks, local banks, you're going to have to put some money down. So when I say money down, what it means is that if you take out, for example, $1 million loan and they want 10% down, you have to pay the bank $100,000 towards that loan. So you bought a practice for $1 million, you put up $100,000, the bank puts up $900,000, which is your new loan amount. And the reason is because the smaller banks want you to have some skin in the game. They want you to be accountable for the money that they're giving you. Smaller banks don't always understand this in dental practices. So that's the reason sometimes you want to go with the bigger dental practice banks. So the next feature is the lengths of bank loans. So there are 5-year notes, there's 7-year notes, there are 10-year notes, there's 15-year notes. For the actual practice, for the dental business, most of the time we suggest doing a 10-year note, but attempting to make payments based off of a 7-year note. So you should be able to swing the cash flow from a 7-year note, but you should be receiving a 10-year payment. So why do we do it like that? So that gives us a little bit of safety margin. So you should be able to analyze the deal and say, okay, a 10-year note at $1 million is, say, and I'm just using math out of my head here. So let's say it's for a 10-year note, it's something like $8,000 a month. A 7-year note would be $12,000 a month. When you're analyzing that practice or analyzing that opportunity, you should be able to make the $12,000 a month thing swing, but you want to do the 10-year note because you want to actually make those payments lower so your cash flow is high enough that you can actually use cash to be able to propel your marketing, your staff training, and your patient experience. So we do pay that loan off faster, but it really depends on the type of loan. So most loans we see are 10-year notes. 15 years is too long, 5 years is too short, but when you're analyzing an opportunity, try and make sure you can swing a 7-year note, but go ahead and sign up for the 10-year deal if they have it. And it comes back to that smart debt versus dumb debt philosophy that I have, that yes, you're going to pay a little bit more in interest, but if you're saving the difference, the spread between a 7-year note and a 10-year note, then you should be able to pay that loan off early anyways. So that brings me to the next area of, with the lengths of those notes, there's 2 different types of ways that they're structured. So there's fixed interest rates, and then there's variable interest rates. So a fixed interest rate is whenever a bank says to you, you've got a 10-year note, and we're going to charge you, say, 5% for that note over the course of that life of that loan. That's a fixed rate. You know what your payments are going to be for the next 10 years. There's also variable rates. That is whenever a bank says, we're going to charge you 3.5% for this note plus whatever the prime rate is, or plus whatever, you know, the bank's intercharge rate is, or whatever it is. And that's saying that you're going to have a certain rate based off of the government's interest rate. So if you're super geeky for whatever reason in dentistry and just really like looking at like what the Federal Reserve interest rate is, or what the bank's rates are, interest rates, if you hear about in the news the interest rate went up or the interest rate went down, then that is what kind of affects the variable rates that are out there. So you will have typically in a variable interest rate, that rate may change like a half of a point. When I say a point, I mean a percentage. Those are different terms, but for purposes of this instructional podcast, that's going to be fine. So your points or percentages will change over the course of that loan. And so what you lock in right now, if it's a variable loan for today's, you might be paying 4.5% today, but at the end of that loan, or 6 years in, or 7 years in, or 8 years in, you might be paying 8 or 9%. So the fixed rates are a lot safer. They're just a lot safer. The variable ones, you can usually get short-term cash flow on it, but the difference in like 1%, even on $1 million loan, is typically not a whole lot when it comes to the difference in your monthly payments. So we always try and say go for the fixed rates. Lots of banks will offer them. Lots of banks will give them to you. So there is also kind of the hybrid of these two loan types. There's the fixed variable, which is what we'll do is we'll say, okay, we'll give you a 10-year note. We're going to give it to you for 4.5%. fixed for 5 years, and then it turns into a hybrid note, to a variable note based off of some rate plus prime. And those notes are fine because typically what we see is 5 years down the road, you'll typically have another opportunity, or hopefully your practice will be up and running to a point to where you can pay it down enough, or you see the writing on the wall of that rate having changed. And so typically, the way that those three shake out, so there's fixed, there's variable, and then there's the hybrid that I talked about. Fixed rates are almost always going to be higher. Variable rates are typically going to be the lowest, and the hybrid is almost always going to be in between those two. So we always say try and do fixed. If it's a 10-year note with a 5-year fixed percentage in there, that can work out as long as you don't have prepayment penalties, which is the next thing we're going to talk about. So prepayment penalties, kind of going back to what we talked about before of having the 10-year note versus being able to pay it off in 7. You then, if you have a prepayment penalty, a lot of these companies, a lot of the big banks, in return for having no closing costs, in return for having no down payments, in return for having very flexible lengths of bank loans, and having good rates, they'll have prepayment penalties. So they're trying to protect themselves from you shopping their loan every year. They're trying to make sure that they're going to be able to recoup some of their cost for giving you these great deals. These are typically going to be negotiable. The better deal you get, the harder it's going to be to negotiate these out. So what they'll typically do is they'll say, for instance, after the first year, you have a 3% prepayment penalty if you pay off the loan, which is only going to be based off of if you refinance, basically. And then maybe they'll say after 2 years you have a 2% penalty, after 3 years you have a 1% penalty, and after 4 years you have a 0% penalty. So basically, if you pay it off after 4 years, then you'll be penalty free. But the reason is because most of their interest on the loan is generated in those first few years, so they have a chance to recoup some of their cost. So you can sometimes get these adjusted down and get negotiated out, but you need to be aware that they exist. You need to be aware that you could be signing up for one of these things, and so you need to be very careful in reading your bank loan information to be able to make sure that works out. So those are prepayment penalties. The next area we talk about is interest rate. So interest rate changes a whole lot. In the last 2 years, I've seen interest rates hover around 5%, and I've seen them drop down to under 4%. They change pretty quickly, actually, which I was surprised at how much they're changing. Maybe that's more of a a story about what's going on in the U.S. economy right now. It is October of 2015 right now. Just so if you're listening to this, maybe in the future, then you'll have an understanding of what context I'm putting this into. But interest rate is typically somewhat negotiable. You can sometimes have banks compete against each other. Some of them don't like that, obviously, but there's no reason to not have a second option sometimes. So the last little feature of bank loans I'm going to talk about are the graduated payments. Some of the bigger banks will allow you to defer payments for up to a year, which is fantastic for startup practices. You can basically, what you can do is you can defer that payment for a year. You don't have to actually take the money. You don't have to pay them anything, basically. You get it. Payments deferred. The problem is with most deferred graduated payments is that you get charged interest for the spread in that time frame. So it's a great cash flow deal, but sometimes it can be a little bit of a red herring. So all of these features that I just talked about after the portion we talked about the conventional and SBA loans, almost all of those are negotiable in some retrospect. In some regard, you can make those work towards your benefit or towards your situation. So the closing costs, the down payment, the links to the bank loan, the being fixed, variable, or hybrid, prepayment penalties, having some type of graduated payments, or in the interest rate, all of those are somewhat negotiable in this process. And how good of a deal you get is going to depend on a lot of different things, which takes me to my number one takeaway. So before I get into my number one takeaway, I want to kind of recap that if you go with a very large bank that does dental loans, they typically can give you the best of those features. Smaller banks, there are some out there that are super flexible and they can give you the same types of deals. However, you can spend a lot of time searching for that small bank. And that's time that can be turning sellers away. It's time that you can be losing out on opportunities for specific locations. There's a lot of different things that you can lose out on that. So be aware that I love small banks. I'm a small business person. I mean, I fight for small dental practices every day, and I fight for being a small business owner myself. I try to support local businesses, but at the end of the day, banks are these giant companies that have bunches of money, and the bigger they are, the better product they can give you. So be aware of that. So now on to the biggest takeaway from the time I've done with dealing with banks in this process and being an advocate for clients. So my biggest takeaways from the dealing with these banks is that you really have to be aware of the different ways that the banks work. There's a lot of moving parts that if you don't have someone in your corner looking into this information, or you haven't listened and taken notes on this podcast to understand the different nuances, the different changes and different subtle issues involved in this process, you can really, really cost yourself a lot of money over time. So getting the knowledge up front can really help you out. I will say the biggest reason that loans don't end up working out is because of the one party not being prepared. So there's obviously horror stories that, on the bank side of things getting messed up, but a lot of the time, especially in acquisitions, the seller doesn't understand why they have to give documents to a bank in order for them to give you $1 million. It's a little bit strange, but you got to understand that these people are from a different day and age. So for example, I'm in Arkansas, so I deal with a lot of deals in Arkansas, and a lot of the owners here just want some spit and a handshake to make these things happen. It just isn't that. It doesn't happen in today's day and age. I mean, we had these giant bank crashes, and regardless of the fact that these companies, the big banks deal with dental practices all the time, they still have rules and regulations they have to adhere to, and so document requests are a very, 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 very difficult thing to get from sellers sometimes. So you have to have someone in your corner that understands that, that can, talk to them about why that is needed. And a lot of the time, I'll be honest with you, it comes down to the doc to be able to get those documents, because the same people that don't want to give those documents over, they really do not want to talk to your CPA or lawyer about those documents. So it comes up to the dentist to be able to sit down with them and say, look, I understand this stinks that we've got to get this information, but I've got 5 different banks I'm talking to, and they're all asking for the same thing. So we're going to have to give it to them one way or the other. And I don't like doing it, but it's something that's required for us to be able to get this deal done. So if you could just please give me your production by provider reports for the last 3 years, that's going to help us get up. And there's going to be more documents they're going to request down the line. It's not a one-size-fits-all thing. They're going to have other documents they're going to request over time. So just be prepared for that. And if you need my help going in and getting these documents, if you need my CPA's help of getting these documents, if you need my attorney's help of getting these documents, if you need my wife's help, my dog's help, whoever, we'll help you get these things done. It's just because we want to get this deal done. And that's a really good way to kind of approach that situation. And so there's also the fact of being prepared if you're doing like a startup. And if you're a startup, then you're going to need to have a good team behind you. It actually talks about this in the interviews that I did with all the 6 big giant banks that do a lot of these dental deals. I mean, hundreds of millions of dollars in dental deals a year, if not billions. They talk about, it's a very common thread that they say, that they'll look at deals that have a strong business team behind them a lot more than they will just people being very willy-nilly about it, just saying, hey, I got this idea of a deal. I don't have a CPA, but here you go. Here's what's going on. They'll look at, they're very serious about using people or getting deals structured and through that already have a business team in place. So that's my number one takeaway, is that being prepared really matters, whether that comes from an acquisition or partnership buy-in or equipment or mergers or optimizing cash flows, things like that. All of those items matter. So from a practice management standpoint, just as a final thought, if your cash is going to be king in your practice, so the reason that these bank loans just typically work is that your cash flow, yes, you have to pay money out for these loans every month. However, the amount of infusion of cash they put in initially is so great, it's so large, substantial, that it makes sense to do that. If you're looking at maybe optimizing cash flow, I didn't mention it in that section, but it's very important to remember that you shouldn't be buying equipment or trying to optimize cash flow without having a very strong understanding of what your cash flow is currently doing. And that is something that your CPA should be able to assist you with. So as a conclusion, we talked about the different types of bank loans, my philosophy on debt, the reasons to get a bank loan, the different features of a bank loan, which are all somewhat negotiable, and then my number one takeaway, as well as kind of a caveat, an additional point about using your cash flow as a business strategy to be able to look at that and have that dictate does this make sense to buy a piece of equipment or something like that, which is kind of just an added thought that is kind of a rabbit trail, so sorry about that. But anyway, so that is my first instructional video about this is an audio only podcast. It's my first instructional podcast. If you find this helpful, give me some feedback. Shoot me an email, jonathan@dentistmetrics.com, or you can leave a review on iTunes. That would help me a lot with this information. Okay, guys, so time for today's bonus. If you enjoyed today's informational podcast, I interviewed 6 of the biggest banks that do hundreds of millions of dollars in these dental loans every year. I took questions from my listeners, from my readers, from my clients, from my contacts in the industry, and asked them, what do you want to know from dental loan people? And they gave us like some items such as, what is the biggest mistakes that dentists make whenever they're trying to get a dental loan? And they all 6 chimed in with all these really great different answers. It's a very in-depth, large guide that has some fantastic answers that will help you in the process as well. So today's podcast was more instructional, about informing you about what the different types of loans are. this guide is going to teach you how to successfully apply for one of these dental practice loans. So if you would like a copy of this guide, simply text the word practice to 33444. That is practice to 33444, and you'll be able to get that directly. Also, in this guide, this is really neat. You can actually click on one of the links and it will actually connect you directly with some of these bankers to start this process and make it very easy for you to be able to get one of these loans. So that's today's bonus. So that's it for today's episode, but that doesn't mean that the learning and implementation have to stop there. I've created a free report called The 15 Numbers That Will Make or Break Your Dental Practice. This report has been downloaded over 1,000 times by dental professionals. So if you want your free copy of this report that's going to outline what the most important numbers are in any dental practice, and it also includes how to look at your numbers, how to set goals, has a whole slew of really important information that is the culmination of all of my experience as a dental CPA, then just go to startyourdentalpractice.com/free gift. That is startyourdentalpractice.com/free gift. And so that's it for today, Ambitious Dentist. Again, I'm Jonathan Van Horn, CPA and ABV. I'll see you next week with another world-class practice owner or consultant that will help you start your very own dental practice. Thank you guys so much for being a part of the Start Your Dental Practice community. If you enjoyed today's episode, please do me a favor and go to startyourdentalpractice.com/iTunes to leave your honest feedback and review on iTunes. It's going to help me create a better experience, a better show, a better podcast for you, the ambitious dentist. Your feedback really does help, regardless if you like the show today or not. If you didn't like the show, let me know, because it's going to help me create a better show and podcast for you. Lastly, if you know of anybody that would benefit from today's episode and today's content, today's guest, please feel free to share with them on social media or through email.